The Panic of 1907. What was its impact on US finance? Imagine a time when the entire financial system seemed to teeter on the edge of collapse. That was the reality in October of 1907. A sudden crisis shook the United States economy and changed how the country managed money forever. It all started when speculators tried to manipulate the market on United Copper stock. When their plan failed, panic spread quickly. Banks and trust companies faced massive withdrawals from worried depositors. The Knickerbocker Trust Company, one of the biggest trust firms, nearly went under. This triggered a chain reaction of bank runs across the country. Trust companies, which held less cash and were less regulated than banks, were especially vulnerable. As people rushed to withdraw their money, many institutions couldn't meet the demand. The crisis hit during a broader economic slowdown. Stock prices plummeted, industrial production shrank by about 11%, and unemployment soared from less than 3% to over 8%. Imports fell sharply, and many businesses went bankrupt. The panic also caused a drop in immigration and disrupted trade and manufacturing. J.P. Morgan, a powerful banker, stepped in to help. Using his personal wealth, he organized a group of bankers to provide emergency support to troubled banks. His actions helped stabilize the banking system temporarily. But the crisis revealed a big problem. There was no central authority to manage such emergencies. This lack of a central bank meant there was no one to step in and provide quick help when things went wrong. The panic made lawmakers realize they needed to change the system. They passed the Aldrich-Vreeland Act in 1908. This law created the National Monetary Commission to study the banking system and suggest reforms. These efforts led to the creation of the Federal Reserve System in 1913. The Federal Reserve became the central bank of the United States, overseeing money supply and acting as a lender of last resort. The Panic of 1907 was a turning point for American finance. It exposed weaknesses in the fragmented banking system and showed how trust companies could cause trouble. It also highlighted the need for a central authority to prevent future crises. The event turned a recession into a deep economic contraction and pushed through reforms that still shape the U.S. financial system today. It was a wake-up call that changed the way the country manages its money and banks.